Hey guys, I'm Richard Allan. Welcome back to the channel and welcome back to another episode of 4-Minute Financial, where I break down my thoughts on a company in 4 minutes or less. Watch till the end of the video and I'll reveal the company to you right before the timer is up. Subscribe and hit that notification bell for more 4-minute financial videos just like this coming soon. All right, I don't want to waste your time. So let's get right into it. Let's start the timer. What are you going to start? Let's start it. Should we start it? Let's start the timer now. All right. What does this company do? This company is the largest mortgage lender in the United States. And no, we are not talking about Wells Fargo. That's right. This company has surpassed Wells Fargo with a 10% market share. And their customers actually love them. They do. They originated $145 billion in loans in 2019, which generated almost $5 billion in revenue. They have a culture at their company based on 19 philosophies that have put them on the Forbes 100 best places to work list for 17 years in a row. This employee-centric and entrepreneurial atmosphere creates a culture of high-scale customer service. That is why this company has been rated highest in customer satisfaction in the US by J.D. Power for the past 10 years. After being in business for 35 years, this company finally went public 2 months ago. So they've only been trading for a very short time, but it's been a bit of a rocky road. So on September 2nd, the stock peaked at $31 per share after IPOing at $18. Then it dropped back down to $19.84 per share just yesterday. Those are big swings in 2 months. But the company is profitable and had a stellar second quarter earnings report. They reported year-over-year revenue growth of 437%. Speaking of growth, let's talk short-term growth potential. This company has stayed profitable through the pandemic and has some of the lowest forbearance rates in the industry. In fact, their forbearance rates are half the average of the rest of the industry. They attribute this to their award-winning customer service and support. Yesterday, they inked a deal with Realtor.com. Now, every time someone is shopping on Realtor.com, they will see an ad for this company's mortgage services. That ad will have a direct link to the mortgage application. With 146 million visitors to Realtor.com last month alone, this partnership is a really good thing for this company. This is exactly why the stock shot up by more than 13% yesterday. I believe there is a bit more upside in the short term, and I think we could see another 20% increase or so by the end of the year. So, but what about next year and beyond? Let's talk about long-term growth potential. This company plans to take over 35% of the market share from its competitors and plans to do it on the back of their digital-centric platform that they've created over the past 3 years. This company has shown tremendous growth in their recent earnings reports, and I believe there is a lot more fuel in the rocket. The fuel I'm speaking of is the record low interest rates we're experiencing. Record lows, under 3%. The potential mass exodus from major cities as people continue to work from home and realize they don't have to live in massive cities anymore just to get a shorter commute to work. Number 3, the backlog of $11 trillion worth of potential refinances, as interest rates should stay at record lows for years to come. This company has 9 subsidiaries that range from mortgage lending and title services to digital media companies that are leaders in online consumer acquisition. So needless to say, there is plenty of growth potential for this company, and there may be a time when Wall Street stops valuing this company as a bank and starts valuing them as the tech company that they are. Really, seriously, with all these subsidiaries, they are a tech company. Okay, speaking of value, I want to do things a little bit different this time. I want to stop the timer right now. Before we talk valuation, I want to tell you what company we're talking about, and I want to give you a word of caution. The company we're talking about is Rocket Companies, ticker symbol RKT. And as I just illustrated, there is some good growth potential for this stock. If they keep doing the things that they're doing and keep reporting the earnings that they're reporting. But if you plan on purchasing this stock, here is my word of caution. If you are using Robinhood to purchase your shares, Robinhood makes this company look like one of the greatest opportunities in the history of the planet Earth ever. Any stock. Look at this screenshot I took from my Robinhood app. I want you to look at the bottom right, and you'll see that RKT has a market cap of $2.27 billion with a PE ratio of 3.081. So if you're making bullish buying decisions based on these numbers, you may think you have an easy 10x opportunity on your hands because a $2.2 billion market cap with a PE ratio of 3 is crazy for such a profitable and disruptive company with $28 billion in assets. However, when you pull the stock up somewhere else, like say Webull, you get a completely different story. Look, the inaccurate data on Robinhood is one of the main reasons I switched brokerages. So take a look at this screenshot I took from Webull. You can see on the top left that the true market cap of RKT is $45 billion. And if you look at the top right, you see that the PE ratio is 9.36. See, these are numbers that make sense. And while we still can paint a bullish picture for RKT long term, we are not going to be 10xing our money investing in RKT anytime soon. Now, don't get me wrong. RKT is still a buy in my opinion for the reasons we talked about in the long-term growth section. But personally, I will not be making any purchases above $25 per share in the short term. I will be paying close attention, really close attention to their next earnings report in early November. If they report anywhere close to the numbers they've reported in the past, especially like the second quarter when they were up over 400%, I will be investing big in RKT and I'll ride the wave for years to come. Remember, they have a very aggressive goal of 35% market share, and if things keep going the way they have been, RKT, rocket companies, could get there even sooner than they even realize. Thank you so much for joining me today. Let me know, what are your thoughts on rocket companies? And if you have an idea for a company that you'd like to see a 4-minute financial video on, submit your ideas. Submit them down in the comments below. I'd love to do a video that you submit your ideas for. And as always, if you didn't already do it, click that beautiful red subscribe button down below, and I'll see you in the next video.